For years, the payments industry sold us on one big promise: faster money. Instant rails, real-time settlement, money that moves at the speed of a text message. Well, now we have it. So here's the real question. If money can move instantly, why does so much of the financial system still feel so slow? Today, we're going beyond the headlines. We're not just going to ask whether payments are faster. We know that. We're actually going to look at what changes have happened. Does speed unlock new economic activity? Does it create real growth for banks? Does it reshape how businesses manage cash? Where is the punch? And where do stablecoins fit into this picture? Signal? Threat? Simply another tool in the system? Just another rail? To unpack that, we have leaders who see this from very different vantage points. Dominic Venturo, Chief Digital Officer at US Bank, David Watson, CEO of the Clearinghouse, and I talk about faster money. What does it really mean? And what's next? Something even faster? It feels like we're really at this inflection point where the world is changing faster than ever, and it's not really going to slow down. So I'm curious, with two gurus of payments, when you look at payments today versus 5 years ago, which probably feels like forever ago, what feels meaningfully different and what's stubbornly the same? And, I can start. It's like the part for me that feels stubbornly the same is, I worked for Deluxe in the early 90s. And I remember having conversations about checks were going away. Checks have not gone away. It is stubbornly the same. So I'd look to you two. It's like, what's different and what just won't give up the ghost yet?
Well, I think you've got me right there, since this morning I received a check in the mail from my health insurance company with some, copay refund for something. So you kind of have me on what stays the same. It's still the usage of checks when there are a lot safer, more efficient, more effective methods to make payments, and continues to be the bear of many of us in the industry that we want to kill. I think the other thing I'd say that stays the same is the pace of change. I think I've been on panels many times where I've spoken about payments as changing and changing fast. And I do feel like that's actually continuing. And it's a very exciting place to be. I'll maybe let Dominic opine on some of his thoughts before I come into what I think has really changed.
Yeah, I think, look, checks won't go away. They are declining in volume, but maybe not as fast as we'd like. They do serve a purpose for some use cases. As much as we'd like to argue there are better solutions for that, but I do think that we've seen a lot of innovation around ways to be able to get checks out of the system. We as the banking industry and payments industry more broadly have a sort of bad habit of creating rails and capabilities but not sunsetting the old ones. So we have all the big banks anyway have these very complex orchestration engines and capabilities to be able to ingest the payment instruction files from our customers and get them where they need to go and route them and do those now in a real-time way that we didn't have before. But the reality is cash and check continues to be pretty persistent. And then when you look at sort of consumer behavior, we've seen cash and check go down quite a bit. So a lot of the tractical problem, if you will, in the check side is in the B2C side of things. And then from the B2B procurement side of things, it's still, trillions of dollars that are being transmitted via check with remittance paperwork actually showing up on somebody's desk.
Dominic, I literally have remittance paperwork from an Alloy Labs member sitting on my desk, a pile of them actually, because you'd be shocked the number of our members that send that. So what has changed the most meaningfully, right? We have seen the introduction of both Zelle, coming into the mainstream, and RTP in this time period. Is that meaningfully different? Like what has actually changed as a result of those? And Dominic, why don't we stick with you? Because you guys have some very interesting use cases before David can opine, kind of in a macro.
Yeah, you think about the tremendous success, and I'll start with Zelle and P2P. You think about the tremendous success that Zelle and P2P has had. We're talking, now trillions of dollars of volume, ongoing double-digit growth, now surpassing what the incumbents were prior to Zelle being created. Well, how did that happen? One of the ways that happened was because it's a trusted solution that's embedded within the banking solution. And that's a big darn deal. That matters a lot to consumers. They want to be able to trust that when they're either sending or receiving money, that they understand that their bank has their back and the processes that go along with that. The other part, though, is the availability of funds being near immediate, if not immediate. So when that transaction happens, you can actually do whatever it is you intended to do with the money. There are so many use cases that I won't go into examples, because I think in the P2P space, most people understand them. In the business space, being able to do things like not do that check for the reimbursement for the insurance claim or for the medical benefits, but instead to be able to do that as a direct payment via disbursements can happen over Zelle, and we're doing those kinds of transactions. Enabling an auto dealer to be able to pay for your car in real time in the driveway after the appraisal. You've seen the commercials about people wanting to turn their car into cash. The earlier versions of those commercials, that transaction was a check. So you were very excited to walk away with the check, right? But now you can walk away with the money actually in your account. That reduces the uncertainty around, is the check going to clear? Are the funds good? Are they guaranteed? They are, all of those things. So there's a lot of those kinds of use cases in both the B2C as well as in the P2P space. That is why we're seeing the kind of tremendous growth that we've seen. David, what would you add?
Yeah, for me, it's the amount of money that is flowing over the pace of that change. If I take RTP as an example, never mind the last 5 years, the last 1 year alone, the value growth has grown, nearly 500%. I think 1.5 trillion was settled over instant payments last year. And when you think that, RTP's average payment value is around $3,000, and actually that itself has increased from 300, but around, a few $1,000s, that's a lot of money moving in seconds, sometimes faster than a second. It's a very, very different environment than where we were 5 years ago in the United States. And it's particularly impressive when you think that many of the very famous examples we talk about, instant payment flows, Brazil, India, they're countries that were leapfrogging, straight to sort of a new state. We have a variety of efficient and effective rails today with ACH, with cards. They're very useful and very good for certain types of things. So we didn't have a big gap to close of lacking things. What we were really doing was looking at those use cases that Dominic was articulating and others, and saying, that's an example where I need money to move 24/7 and instantly. That can now happen in the US. And it does happen to the tune of, $1 trillion+ last year, and growing at 30, 40, 50% per year in terms of transaction volume. So that's a huge difference from 5 years ago, where we had either nothing or we had it and it was very nascent and no one was using it. So that growth of instant payments is quite impressive, whether it's Zelle, whether it's RTP, other spaces. It's definitely leading to a very different dialogue around not just speed, but when I can pay when I want to pay, and regardless to what time of day that is, I know it's going to get there instantly.
Well, you both have brought up an interesting point, right? The leapfroggers, coming from Africa, Brazil, India, that did this, they didn't have a rail, so they had to add the rail. And I'd say one of the big challenges we have in the US in particular, and some other places, but really a lot of US, is we had sufficient rail, so it needed a real use case to drive change. Like the uncertainty, Dominic, that you hit with the car. Like, especially when you're doing a person-to-person transaction of a car, or you're a dealer, right, and you want to make sure the check clears before the car drives off the lot, you need a real use case. So I'm curious for both of you, what has driven this rise in the last years? You said, David, is it the technology becoming more mainstream? Is it the behavior, the risk tolerance, the economics? Is that at the bank level? Is it at the business level? What's actually making this happen now, when it kind of was a slow burn?
Well, you got to think I always compare infrastructure in financial services a bit to like infrastructure in transport. So to say, It's great, I've got this super fast, train, but there's no rails going anywhere, or I really want to get there quickly by train, but if there's no tracks, you can't go there. So you have to, first of all, build the tracks or build the network or build the airports for the flight network. Then you obviously need to understand that, okay, we have them. How do we make things move on those tracks? It takes time to build that infrastructure. You then need companies to come on board, airlines or trainish, companies or others to start using it. And I think that all takes a bit of time. But once you have the network and once you have companies using it, in this instance, banks for that analogy, that's when you see the surge of people suddenly saying, oh, wait a minute, I can get there by that mode of transport at a much easier, faster, or more efficient way. And then you can pick and choose the mode that you take. I think for us, when it comes to real-time payments, really focusing on those examples where I want to do it outside of business hours and I want to be able to do it either as early or as late or just simply under my control as being key. But also understanding that the modes of transport like ACH, for payroll doesn't need to change. I don't care if my paycheck comes in at 1 a.m., 2 a.m., or 3 a.m. I just care that the money is in my account when I wake up in the morning on the day that I was expecting it. Whereas if I'm a gig economy worker who's building a website and wants to click it live, I want to get paid as I click live because I know that's a sort of a pay-per-play, or a service industry worker that wants to clock out and get paid instantly. They're able to do that now because the infrastructure and the rails are there. 74% minimum of accounts in the US are connected. In fact, many B2C dispersers we talk to access more than 95% of their end accounts on the RTP network. So you can do it now. I think that's the difference. You have the scope to actually access where you want to. And I think that growth's only going to get faster and faster for both Zelle and for RTP over the next 5 years.
So I think, I'm going to pull on that thread a little bit, David. When you think about use cases, I think sometimes simplistically we think about, it's 24/7 and it's real time, which it is. But think about this. When and I'll use our merchant processing business as an example because I understand it well. We settle with our merchants every day for their transactions, but we historically had settled over ACH, right? So they would run credit card transactions all day today, and then we would settle it via ACH, and they might actually get the money deposited in their account for the things that they sold in a day or two. And if we were using same day ACH, maybe the same day, but because of, some operational vagaries, not always. Value proposition extension to that as a merchant processing provider is when you do your merchant processing with us, we'll settle your funds instantly. So when you close out your settlement, you actually get your money. That's no different than if somebody paid you cash over the table. You actually have your money in hand. It turns out that's a big deal. It's a really big deal for small businesses who are working capital challenged. They don't have the kind of cash capacity, treasury management groups that very large companies have. So it's a differentiator. I use the auto purchase as another example, but we've seen countless kinds of places where a company says, how do I leverage this capability to improve my value proposition? I have gig drivers. I won't name the company, but when they're done with their shift at the end of the day, they want their money. And guess what? They use real-time payments to be able to pay those drivers. So those are examples of where companies are actually innovating based on the thing to improve their value proposition and competitiveness vis-a-vis the rest of their landscape and the kinds of employees, gig workers, or business relationships that they have. So it isn't just always about moving money. Sometimes it's where the value is actually being added.
So on that point, and David especially push on me if this is an outdated view of the world. I saw this rush across banks, big and small, that were all turning on RTP receive, right? Like everyone wanted to get the money in faster, but everyone was worried about that same money flowing out faster. Certainly heightened post Silicon Valley Bank, right? Where the only thing that kind of slowed that down is the collapse of their wire room in getting out large sums of money. The use case that Dominic described in terms of paying drivers in the car are serious ones around adding value to send faster versus receive faster. Has that flipped? Like when you talk about the trillions of dollars being sent, is that concentrated in a few use cases? How does that play out?
Yeah, so I mean, a couple of things. I think the Silicon Valley Bank collapse was hilarious for me from the sense that I was relatively new CEO of, the company that runs the only at that time and still by far the largest, 98% market share of instant payments. And I was watching Bloomberg about this, massive issue of all these instant payments to and from Silicon Valley Bank and how instant payments was going to, accentuate this collapse. They weren't actually live on the ability to send any instant payments. So it was never going to actually accentuate that. That was once again a little bit of a myth. And then the next day, a lot of people it came back on Bloomberg and everyone said, oh, it's great. It's great they were able to send instant payments, the opposite of what they said the day before, because we were able to get money out quickly. Well, again, they weren't live on it. So there was a bit of a misconception around how and what the role instant payments played. But I think what instant payments does do in such an example is give control. I can actually stop a payment from going as soon as I know there's an issue. Whereas in the current system, you sometimes have a situation where you've sent a payment, you don't know where it is, or it's stuck in a settlement system for a period of time, and you can't claw it back. So actually the ability to stop immediately is a very, very different control. Second to that, the ability to just move it under your control as a corporate treasurer, as a financial institution treasurer, you just have more control. It's a push payment. People can't make debits on your account. You have complete control over that. And that is, I think, a key point when it comes to when we look at that sort of bank crisis, if you like, example. But I think what we really see in terms of the movement of the use cases around this has been interesting, because it really started with, a lot of B2C disbursements, and we still see big growth there, and a lot of P2P, either Zelle settlement that some banks do or non-Zelle P2P type payments, really consumer, whether it's consumer to consumer or business to consumer. When we increased the limit last year from 1 million to 10 million, that's when the value exploded coming over the network, this 500% uptick in 1 year that I speak about. And that made we actually didn't expect that. We always intended to raise the limit. We'll raise it again in the future. We take a risk approach to sort of control, look at different data, fraud data, other things. When we raised it to 10, we were surprised. But what surprised us, or we didn't expect quite so quickly, was the corporate treasury demand to move money instantly. And again, that's not necessarily to move it as quickly as I can, but more to move it as late as I can. If I get 30 days to pay, I probably want to pay on the 29 or 30th day.
I was going to say 29 and a half, days.
Yeah, exactly. So that puts it back in your control. You can do that. And I think that's seen a real explosion in the sort of the B2B and corporate treasury and even financial institution treasury, actually, over the network. And that's actually where we've been getting requests to further increase the limit so that people can move money from a B2B perspective or even an FI to FI perspective much faster and more quickly.
Hey, just one quick thing, because I think, if you're watching this or listening to us, this discussion, you might immediately go, well, that all ate into the wire volume. Real-time payments, the massive growth, et cetera, disintermediated wires. This is a debate a lot of the banks were having in the early days. The reality is, whether it's CHIPS, which is the clearinghouse, or Fedwire, both grew year over year, even with the limit increases and the volume increases. So we're seeing total growth of money movement. And it's not really, I'm not saying it's not eating into wires, because it is to some degree, but still the total volume is actually growing.
That's a really great point,
that
Dominic.
to? Go, David. That's fascinating.
I was just going to say, I can give some real numbers there for the listeners, right? We run the largest private side wire network, in fact, the largest private side wire settlement network in the world. We run an ACH network, we run a check settlement network, and we run RTP. What I can say that is year over year, wires grew on our network 12% in terms of volumes and value. We had the first record value day in wires since the 2008 financial crisis. We saw ACH grow 4.5% to 5. And again, we saw both volume and value, transaction records last year. And on RTP, it grew well over 30% year over year. And of course, it's a new network. It has new records being set every couple of days. So it's amazing when you think, 5%, 12%, 31%. There's enough growth in payments for everyone, and cannibalization will happen between those networks. But people are paying more money and more often, especially electronically.
So it raises the question then. It doesn't appear to be just about the speed then. It's the everything else around the real-time payment that becomes the value. David, you mentioned the control aspect of it, right? Like wires have very little to no control. In fact, last wire I sent last week for something, the other large bank, not US Bank, sorry, Dominic, but you're not in one of the key locations that we would need you for our team. But, like big disclosure I had to click on that once I send it, they're not going to stop it. Right. And, RTP and others give you some sense of, both that control. Can we talk a little bit about, the data, the timing that, sending it at, the 11th hour sort of thing? What else, if it is real time, it turns out the real time is not necessarily the key aspect of it. How are these other things playing in?
Yeah, I think I've always believed that the RTP network's greatest value, speed is just one actual small part of that. Because whether a payment settles in seconds or 30 seconds or a minute or 3 minutes, it matters in certain use cases. But for a lot, what's more valuable is one, the 24/7 aspect. So more than 45% of the dollars cleared over the RTP network last year were outside of traditional weekday business hours. So, just under half, if you like, of payments were made outside of 8:30 to 5:30 Monday to Friday. So that shows you there is incredible demand to make more payments in the evening when you get home from work, when you go to the car lot and buy your car on a Saturday because it's the only time you can do it, or, there's real demand for that kind of movement. And that I think is incredibly, incredibly important. And when you supplement that with, you mentioned you're sitting with remittance paperwork on your desk. Well, RTP is also ISO 20022, very rich structured data. Hopefully that means a lot less paper, if not no paper, on people's desks when it comes to how you make and send information with payments and what they're for and why you're receiving it or why you're sending it. And actually, I think it's really the combination of the richer structured data, the 24/7 nature, yes, the speed, the resiliency that comes with a brand new platform that is, heavily invested in, by the owner banks of the clearinghouse. It's really the combination of those factors and more that when you add in that it's a push payment network, therefore you get control over your own account and your own money, and fraud rates, excluding scams, are 0.001% on the RTP network today. Now, I think it's really the combination of all those things that make it valuable, not the real time that's the first two words of the brand.
Dominic, are there any of the use cases where it is more than the speed? Because I think your example on, car purchase, and I think home fits neatly into that, right? Where you want, before you hand over keys to either one of those, you want to know that the money's there. But do you see clients taking advantage of the control or the data that's coming with this in a way that it wouldn't have been enabled without, that kind of payment?
Yeah, well, I'm going to just leverage some of the examples I gave you, but I'll answer your question this way. Think about the merchant settlement example that I gave you. As David mentioned, it's 7 days a week, 24/7. So our merchants are getting paid for their transactions on Saturdays, on Sundays, and on holidays, whereas before they wouldn't have. In the case of insurance disbursements, one of the biggest problems insurance companies have with disbursements is they mail checks and they have no control over what happens after that. Sometimes they have to chase down customers, remind them to deposit the check. There's somebody who's worried about this check that was sent that hasn't been cleared because it's a liability on the insurance side, right? Until it's cleared and the consumer is paid. If they can send that over a real-time payment in Zelle, they know when it was cleared, they can clear it out of their back office, and that person doesn't have to continue to fret about where all these checks are. Turns out that's expensive for them. Right? Same thing within the remittance processing and the B2B payments and the reconciliation. You have folks that are taking the invoice, the remittance, the payment, it comes up short, whatever, and they're trying to reconcile it. And then there's all this communication that happens over email. It's massively expensive sort of engine room operations for the accounting groups within the companies to do all of that. So the real time is an aspect. But the end-to-end, the settlement, the auto adjudication, the clearing, the reconciliation, those are business value drivers that at scale make a huge difference.
Fantastic.
I got to build on that example, Dominic. I got to build on that example because twice in the last 2 months, I've had to Google sort of a random set of words where I see an ACH payment to me. So it's a positive, problem. but I didn't know where it came from on my account. And I'm Googling this, few words to try and work out who paid me money. Now, it turned out it was actually payments from my own FSA account where I'd moved it from checks to sort of, electronic payment. But there wasn't enough information coming through on an ACH payment other than this kind of random section of letters. With that example as an RTP, payment, you would have much richer data to be able to know and understand where it came from. Now, that's me as a consumer. Imagine you're managing a corporate back office of a big MNC. That's right. A lot of data you need to understand for those payables, receivables that you can now receive in a simple, structured manner, consistent with how you get that from other countries around the world who are also using that same ISO format.
I get the same problem on the business front, David, where our CFO will ping me and be like, what's this? Normally it's a positive, right? I remember when we're sending money, if it wasn't from them, if I did it, because I do it so rarely. But when it comes in, it's like, I don't know. Well, why don't we take a quick break here? When we come back from the break, we'll talk about whether, is this really becoming a table stake or is it a growth engine? And can we really talk payments without talking stablecoins after the break on Breaking Banks?
Hey, let's take a quick pause here because I want to tell you about a conference I actually like. If you've ever gone to a fintech event, worked the room and left thinking, I met a lot of people, but nothing really moved, you know the problem. Fintech Meetup is different. It's designed around outcomes, not wandering the expo floor. And that fits us well, and that's why we appreciate their support of the show. Last year, people booked more than 50,000 double opt-in meetings. And that matters because it means you're not guessing who to talk to. You're sitting down with buyers, partners, and decision makers you actually want in the room. That's also why Jason is spending time there this year. He'll be leading a very real, very grounded conversation on AI, no hype, no futuristic nonsense, just what's actually showing up inside financial institutions and what leaders should be paying attention to right now. So if you're already thinking about your 2026 calendar, tickets are already on sale, and you can save if you register before March 6th. Just search FinTech Meetup and check it out.
All right, and we are back. And so let's talk about this rapid change. In fact, I think those who jumped on the rocket ship of instant payments, are experiencing unprecedented growth. Those who were not on the ship when it took off are, looking to catch up. The question becomes, it's not often that you look at infrastructure and an infrastructure upgrade turning into a growth story. But Dominic, I'm curious from the U.S. bank story, is it a growth story? Is it somewhere that you can say, hey, we can attribute a lot of value that actually impacts the bottom line?
Oh, yeah. Well, for sure, it's a growth story. I think, so think about it this way, and I'll just sort of encapsulate this within I'm going to use the treasury management group as an example, right? So they've got a collection of products and services. They help companies manage their treasury management activities, which includes, accounts receivable, accounts payable optimization, that type of thing. So there are opportunities, and we have taken advantage of those to provide value to our customers. So whether it is helping customers optimize their payment flows, we were talking earlier about the speed, and it's yes, get the money there fast, but maybe let it go at the last possible minute. But that also could be optimized to be able to get the right discount and take advantage of trade terms and the like, or more importantly, to make sure that you don't lose the trade terms because the funds don't get there in time as stated on the invoice and the like. So you can manage that and optimize that in a very automated way. That's a big deal for companies, and they're willing to pay for that service, right? So when we are able to truly add value to improve business operations, we can make a business case around how that makes sense for the customer, and then ultimately why that is something that we get paid to do for them. It has turned out to be a growth engine for us. So we see good growth in the business itself, sort of the collection of things related to the payments facilitation and real-time payments specifically, because they have been growing so fast, tend to have above market growth rates compared to traditional payment rails. So you think about something that's growing at double digits versus the traditional sort of space that might be in the 5 to 8%, 6% sort of growth range on an organic basis. So it's nice to be able to have products that in your portfolio, some of which are growing double digits, that sort of help lift sort of the average overall. But it is absolutely an area in which you are charging fees for value add. You're adding true value to the customer. We talked about some of how we do that. And then at the end of the day, that business case becomes a meaningful part of the total solution of products that we have.
And I think there's another angle as well, Dominic, which is always one that you can never sell to your boss, which when you're asking for investment dollars, revenue and growth always works, but then you try and tie in like the softer factors of time saves in operations and other factors. But nearly every institution that we've had go live on the network comes back to us afterwards and talks about the, either the cost save or the capacity free up of instant payments versus ACH or check or other things, because you don't have that. I'm waiting. What was the example we spoke about earlier? I'm waiting to try and find where that check is. Is it lost? Is it coming? Or we need to wait for the ACH batch, or even more importantly, when there is an issue, it's stopped instantly. It's not a question of we have an issue. Where's that file I sent yesterday with that, list of payments, and therefore the recourse in fixing once done also doesn't mean you need to redo things. Go process that file again, or other things you need to do, because when there is an issue, it stops, and then once it's fixed, you can start again. Now we don't have many issues. I would say our resiliency is phenomenal, but we're a big network, and the bank back offices and other things really can be a lot more efficient and effective and free up capacity for other things.
So, David, since you brought up, the speed of payback, what are executive teams getting wrong when they ask about how fast is this payback?
Yeah, well, to me, it's about use case, right? I think if you really want to look at payback on instant payments for yourself as a fintech, as a TPSP, third party, software provider, as a bank, like getting into it is one thing, but you got to understand why you're getting into it. And some of them did it just because of hype and then didn't do anything. And we're like, okay, well, I don't have any payback for this investment. Well, yeah, because you're not going out and looking at the clients who want to do, car loans on the car lot, who want to have, instant gig workers being paid from, instant wage access, or service the service workers who, the truckers or others who want to get paid at the end of the shift. So it's not just about implementing the infrastructure, then expecting instant payments to fall out the sky. It's actually a conscious business decision of, hey, I want to go and get more business for my clients and with my clients and solve my clients' problems with this better solution. Therefore, I'm going to go out and sell and target to them why these things are beneficial. That's the institutions, like US Bank, like others that have been first movers here, who've seen the fastest growth earliest. And they're the ones getting payback, because they've actually understood that it's about going where you go for what you want.
David, if you were advising, and Dominic, I'd love your thoughts on this too, a bank that didn't get in early and have the first mover like US Bank did, do they need to be thinking about ROI in a different way? Is it still going to be a growth engine for them, or is it now they've moved into defensive posture that they either get it or they risk losing customers? And Dominic, I think that equally applies to lines of business within US Bank and use cases within US Bank where you weren't necessarily the first mover.
I mean, I think at the end of the day, every business has to make its own decisions, and they're going to vary based on their customer composition and the customer demand. But one thing we know is true, and I've been, in banking and payments long enough to see a number of these cycles, that as we start to see, as David mentioned, the endpoint ubiquity increase, right? So you have the density of endpoints into the 90 percentile of places where the money can go. If you're not in that percent, soon you will have customers who are saying, how come I can't do this? How come I can't receive this payment, or how come I can't send this payment in this way that other businesses are doing, and the like? So, then having to justify a project that is based on I have a competitive gap, but I don't know what the business opportunity is, a tough discussion to have. because then you have to talk about how did you get in that place in the first place. At the end of the day, those are difficult discussions. Now, maybe the decision was to wait on purpose until the market matured and we saw network effect take off. But where we are with the size and scale of the network, you think Zelle sort of went through that same cycle, but a few years earlier, where originally it was a handful of banks, then it was many of the banks, then it was extended through Visa debit capabilities, and then all of a sudden it was ubiquitous and everybody had to have it. Because if you didn't have it, it was on the list of what we would call the customer consideration must-haves before they would choose to open an account with you. And you went from I don't need P2P to now I can't open an account because I don't have a capability that is on the short list of must-haves. That's a terrible place to be. So I think that's just the way you have to think about the evolution of the market.
Yeah, we see that actually. We see that we obviously sell our services directly to banks, right? I mean, we're a network where banks connect and clear and settle between each other, and that's the same for all of the different networks we run or the public competitor that we have runs. What we actually have a lot more in the last year, 2 years, is direct discussions with corporates and other, small to medium enterprises who are actually saying, hey, which banks are able to send on your network? Because I want these services, but I'm not being offered them. And of course,
I have to be very careful. I love all my banks equally. I certainly, like my children, would never pick my favorite. It's my youngest son, but anyway. But really, it's about understanding that the end customers actually want these things. Now, yes, they may not be knocking on your door and saying, can I have RTP? Or can I have a real-time payment? But the one they are saying is, I want control over my money. I want my money instantly. I want to be able to pay as late as I can. I want richer data. I want to do this outside the standard business hours. All the things they say are the problems. When you put them together, we have a solution. And I think banks that are slow to move to understand that is still growing 30%, 40% year over year. And it's still small. The growth has only just started, I honestly believe, and it's still time very much to get in. And there's also an advantage to being a follower versus a leader, right? Leaders have advantages because they can get those things early, they can show those skills, they can acquire the first mover corporate clients, pay fintechs and others who want to come in. The followers have the advantage that the first day they go live, they receive instant deposits. We have banks who receive millions of dollars in the first 24 hours for their customers that they go live. So that's because they're a follower. So that side of the business case is actually more attractive now than those who went first because there wasn't any volume or flow in the network. So there's also a bit of balance to it.
And you're welcome.
The trailblazers.
Some of us had to go first to build it out. That's right.
Right. Without dying of dysentery on the Oregon Trail.
That's right.
Well, one thing, we might not have customers wandering into a branch asking about, an RTP or same day ACH, but I think stablecoins have certainly reached the level of common vernacular now. And it's one I don't have easy answers to. So I think, every conversation around payments has to include something around stablecoins. And despite being kind of, someone steeped in the space, I have more questions than answers. So, let's put some context into the narrative. Dominic, what problems do you think stablecoins genuinely solve in the U.S. first? And let's talk in a macro, because outside of the U.S., I find a lot more answers to that versus, is it actually a big improvement from some traditional rails?
Domestically?
Yeah.
When you say inside the U.S., you mean domestically for domestic payments? Okay, so first,
domestic or sending outside the U.S., right? Because I'll just call this out there and knock this down. Here's my straw person: is for most cross-border payments, there's a relatively good substitute out there that the burden of switching all of your work to use stablecoin to do it. Is there enough juice to make it worth the squeeze?
Just a couple of things. First of all, we have a digital assets business unit. So I'm going to say this and at the same time recognize that I have a digital asset business unit.
Yeah.
We are at peak hype cycle, right? So we are, if there ever was such a thing as the top of the peak before you head up into the trough of disillusionment, to use the sort of, industry phrase, we are there. If you were trying to do the GPS locator. So what do I mean by that? That doesn't mean I don't think there are use cases, but it does mean that I think that, they will start to rationalize themselves to where they actually provide real value, and where you have the opportunity to wring out some significant operational efficiencies, or to really improve the way liquidity is managed. If you look at most of the trillions of dollars that are sitting in stablecoins today, the very largest value proposition that they add is they give you the ability to move from an alternative asset, otherwise known as a crypto asset or some other alternative investment that is highly volatile. And you want to be able to move from that very volatile position to cash whenever you feel like you have to get out of the market. And stablecoins have traditionally been used up till now. And part of the reason why you see so much money in there is because folks are using that to go from here to there in real time, because you can do it just, moving the bits on the wallet, if you will. So that's part one. Part two, another use case is maybe I'm not moving out of assets into things, but I want to keep the dollars US dollar denominated because I might be in a country where I have more volatile currency. And so I'm hedging my currency risk. So if you think about a currency that's got 10% inflation, I want to be able to keep things in US dollars. Now, I'm not a lawyer. The legality of some of that is questionable. It's gray area, whether or not you're violating that country's laws. So I'm not going to go into those details. I think when you think about where banks see the opportunity, we obviously will have to comply with all the laws, AML, BSA, and all those things that are super important. But in the cross-border section, what we hear from large companies is an interesting opportunity to help with the liquidity management on a global basis. So being able to move money in a real-time way, in a more operationally efficient way, and to know with certainty that the money got where it was going and that it's been accounted for, reconciled, auto-adjudicated, and all of that. Stablecoins have the ability to have programmable language in them, so you can make part of that as part of the programmable asset. Then you have the benefit of knowing that you've got a trusted bank issuer that has the currency reserves and the treasury reserves that are dollar for dollar back behind it as required by Genius. You now have an instrument that is highly trusted. There are examples of stablecoins that were pegged to $1 where people lost money in the past, pre-Genius, right? So Genius helps solve for some of that. We've got to solve the market infrastructure through Clarity or whatever the act is that ultimately replaces it, if there is one. But the point is, we have the opportunity to have a financial instrument that has the appropriate governance and oversight and has the benefit of the liquidity. So I'm going to give you a simple example. We did our first cross-border stablecoin transactions within our world. So within our legal entity in Ireland and within the US. If we had done that with a wire, which we could do back to back, we're looking at a couple of days to get the money from here to there, fully settled, cleared, and everything with an international wire. We did a stablecoin transaction issued in US dollars and redeemed in euros. It took less than an hour to get to where it needed to go. And then because of market settlement windows and when banks are open, the clearing happened the next business day, but still much faster than the wire. But importantly, because of the traceability that you get on the blockchain, we knew with certainty within literally minute that the money went from here to there. And then the rest of it was the operational processes and accounting processes within the finance side of the house. So, we've been doing those transactions and we're ramping up the volume, just moving our own money around, which we have to do anyway across those entities, to begin to prove out those cases, market the timings, do the before and after, compare it to a wire, look at the cost, build the value proposition and the like.
David, do you agree with that? Pick that apart for me. Is there a counter?
Sure. I mean, the answer, as always with these things, is yes and no. And I think I liked what you said at the beginning, where you have more questions than answers. I think that applies to every payment professional in this industry right now. We all know there's potential,
but we all have a lot of questions. And anyone who says that they don't still have questions is a liar, or I'm more worried about what they're saying. But for me, I see value in stablecoins. I see value in tokenized deposits. I see value in fiat currency. Again, it comes back to where's the right place to use it and what's the easiest mode of transport to get there. When we talk about those kind of cross-border high-value movements that Dominic talks to, I used to work at Swift. payments business for a global European bank. There's a lot of issues in international cross-border that actually can be addressed in a different way. Now, could we address them with legacy fiat systems? Yes, but sometimes you need that trigger to wake up and understand that we need international interoperability of 24/7 richer data and in better ways than we do today, with programmability, with traceability. I think, can we spend that and update our fiat rails to do that? Yes, but maybe there's an easier way to leapfrog, or maybe there's good reason to do both. And I think when we talk about domestically, I have a bit of a different view around stablecoins than I do internationally, because domestically, I can very easily move money 24/7 today, instantly, with large elements of traceability. What I'm maybe missing is the programmability. Well, maybe it's easier for me to address the programmability and some of those other things in what I have today than go somewhere completely new. And then I actually think, well, actually, if I look back at history, when we started with electronic payments, everyone said checks would die, and then we worked out a way through Check 21 to make checks electronic and e-checks. But ACH came around, we said, we need things to happen quicker. So we introduced same-day ACH. I think there are ways for rails to, continually evolve and improve beside the introduction of new rails. And sometimes, yes, we do need to think about when's the time for rails to go. And I think we're having that conversation more and more around check in this country. But I agree with Dominic, it'll be a while. But I think having 24/7 ability to clear and settle fiat instruments alongside a way to do that for digital assets of different types, tokenized deposits, stablecoins, other things, that's what we're going to be sitting in a normal world in 5 years' time. I truly believe that. What I think we will be able to see in 5 years' time is, where did the money flow, which solved which use cases better, what kind of use cases stay where they are, like payroll stays on ACH, but gig economy payments have moved to instant payments. What will move to the stablecoin environment, other than the sort of on-road off-ramp for crypto and the cross-border example that I do see demand and need for today, will be a question.
Yeah, I think just two things domestically. I didn't answer your question, but I think, I don't think there's much opportunity for traditional domestic payments with stablecoin transactions, but I do think there are some edge cases. I gave you the liquidity example or the safe harbor example of folks that are in the crypto space and stablecoin. The reality is we have a lot of customers that are investing in alternative assets, and they domestically might want to have the ability to move their money to a US bank or a ABC bank stablecoin in their wallet, even though it's domestic, and then be able to repatriate those funds and convert them to fiat. So it might go crypto to stablecoin to fiat, and the banks may create those rails that enable that to happen. But in terms of buying a car or buying a house or going to the grocery store, I just don't see how that's going to really take off, given all the things we talked about that already exist.
Yeah.
So as we come to an end, let's talk about preparation rather than prediction. Question for each of you is: we look at instant payments, not just stablecoin, but where instant payments are going, inclusive of those stablecoins. What's the biggest risk for an institution that's really underestimating this trend that's taking off right now, that they're underestimating the impact of the moment? Dominic, why don't we start with you?
I mean, it's like any new opportunity. The folks talk a lot about first mover advantage and the ability to capture market. That's not the risk. The risk is, I think folks misunderstand what happens with first mover advantage, which is you may lock up an entire series of use cases with a particular industry or a particular segment. Once they have done the engineering work, the integration work, and the implementation work that it takes to do that, it is very, very difficult to unseat them and to cause them to change their solution provider. So the risk is that you lose an entire segment of the market that maybe matters to you, or more importantly, matters to your customers. That's sort of the risk.
Building on that one, Dominic, we saw that. I mean, we can't talk banks and corporates, but we saw that in the last 5 to 7 years, where very large payment B2C companies moved from one bank to another because that bank was not a first mover and this one was. It still sits with the destination bank because of that hardwiring and the relationship side and broader
That's
things.
Right.
But for me, I think there's also this point around, if Do you want to be a bank that's, 50 years ago, 40 years ago, would you want to be a bank that can only clear checks while all the other banks down the street from you actually can enable an ACH? No, you'd be dead in the water. So if we fast forward that analogy to where we are today, do you want to be the bank that can only do an ACH and a checks, but can't do an instant payment and or eventually a stablecoin or tokenized deposit? If you don't think about, and if we don't learn from history, we don't learn from anything.
The last thing I would say on the risk side, just Jason, really quickly, so think about where we see massive growth in the United States. Technology, AI, infrastructure for technology, for AI, fintech, there are massive growth there. Those companies, their leaders, their employees are very tech leaning and centric. So the other thing to think about is they may not actually understand that stablecoin isn't any better than RTP, and RTP already does it. What they do know is everybody's talking stablecoin, everybody's going to use stablecoin, and I want stablecoin, and if you don't have it, that's going to be a negative thing. I'm sorry to say it that way, but that is literally the reality of what you have to think about when if you don't understand your customers and what resonates with them, then you're missing the market.
Yep. Yeah, I got to build on that. I got to build on that, Dominic, with one last one, which is we keep talking about how AI is going to start making decisions for us in our personal lives and our corporate lives. If you think AI is going to be emotionally attached to legacy rails because some old investment went there, no way. It's going to pick the fastest, most efficient, most effective, what makes the most money for its, whoever it's doing it for, whoever designs it. So therefore, if we're actually going to take this out of an emotional, often decision around, I like writing a check, or I like ACH because I've known it for 30 years, or actually AI is also going to drive us and drive those payment flows to the fit for purpose rail, which will be, real-time payments and aspects of the digital on-chain landscape.
Well, and especially that emotional aspect, David, of the check feels safer, or it feels more convenient because it's, I can pull out the checkbook in a sock drawer, or I've got the bill pay loaded, right? Like those are all feelings. And to your point, those feelings are not necessarily grounded in the reality of how those payments actually move.
That's right.
I love that aspect.
Move the emotion and things will be different. And that's what AI will do.
Well, thank you both for sharing your thoughts as how the faster money is really becoming table stakes. And it's not really a question of whether you are going to redesign the system. It's really where you're going to play in the system that is going to be redesigned around you if you want to play. And maybe I'll go start a bank that all we do is cash checks, because that'll be our unique value proposition.
Good luck with that.
Thank you both.
Thanks, Jason. Thanks for watching.
Thank you, Jason. Thank you, Dominic.
That's it for another week of the world's #1 fintech podcast and radio show, Breaking Banks. This episode was produced by our US-based production team, including producer Elizabeth Severance, audio engineer Kevin Hersham. If you like this episode, don't forget to tweet it out or post it on your favorite social media, or leave us a 5-star review on iTunes, Google Podcasts, Facebook, or wherever it is that you listen to our show. Those actions help other people find our podcast, and in return, that helps us build an audience that can be supported by sponsorship, so we can continue to provide you with our award-winning content every week. Thanks again for joining us. We'll see you on Breaking Banks next week.